The 2017 tax legislation has significant implications for all businesses. That's why KPMG has created this video series, Tax Reform, Big Changes, Important Questions, to help you prepare. Today's question is, does my trade or business generate the kind of good income that's required for the new 20% deduction for some business owners? Or does it generate bad income that's not eligible? It's not a simple question, so let's break it down. Unless the owner of a pass-through business has taxable income below certain thresholds, they're going to want to know whether their trade or business is good or bad. That is, whether their income is from a qualified business or from a specified service business. Step 1 is to figure out if you have a bad specified service business. This is a relatively broad category and includes a number of service businesses. It may also be any trade or business where the principal asset is the reputation or skill of one or more of the employees or owners. If you are in a specified service business, then the 20% deduction is generally not available for most taxpayers. So you can see that distinguishing bad specified services businesses from good qualified businesses is key, but you may not be done. Confusing as it may sound, certain rules may still treat a good qualified business as a bad specified service business. Here are some rules to consider. If only a de minimis amount of a business, generally 5% or 10% of gross receipts, is from bad activities, that doesn't taint the good business. But be careful. If the de minimis amount is exceeded, the entire business is a bad specified service business. Said differently, if you have a trade or business that generates 80% good income and 20% bad income, the entire business is treated as a bad specified service business. This cliff effect has been surprising to some taxpayers. Adding to the complexity, a good qualified business might be tainted by a bad specified service business if there's sufficient common ownership of the two businesses. That is, under the proposed regulations, if there is 50% or more common ownership of the businesses and 80% or more of the sales from the good qualified business are to the bad specified service business, then the good business is treated as part of the bad business. Under the final regulations, however, if a good business provides property or services to a bad business with 50% or more common ownership, only a portion of the good trade or business is treated as a separate bad business. There is also another rule in the proposed regulations that would force an incidental good business, generally 5% of gross receipts, to be treated as a bad business, but this rule is not in the final regulations. To summarize, to better understand what this deduction might mean to your pass-through business, you'll likely want to consider the following. Do I have one or more trades or businesses? Do they generate good or bad income? Will my good activity be treated as bad activity? And is there any restructuring that can be done to protect the good activity? Figuring this all out may require digging deeper into the relevant rules, which for 2018 returns may mean looking at both the proposed and final regulations. Remember, you can apply either the proposed regs or the final regs for your 2018 return, but you have to apply whichever you pick in its entirety. You can't pick and choose provisions from each set of regs. Want to know more? Watch one of our other videos on 199A for more information, or visit KPMG's tax reform webpage, read.kpmg.us/tax-reform.